Two very different systems became the most productive trade partnership of the modern era. For nearly 3 decades, it lowered prices, lifted profits, and quietly rewired the global economy. If it was such a bad deal, why did it scale so fast and last so long? And if it worked so well, why did it eventually become politically toxic on both sides? Here's the frame. This is not a blame story. It's not a morality play. It's a systems story. Because what broke this model wasn't failure, it was success. At a scale nobody fully priced in. In this video, we'll do 3 things. First, the original design, and why it made perfect economic sense. Second, what the system delivered, and why nobody panicked early. Third, why success itself created pressures the model couldn't survive. Part 1. The original deal. Why it worked. Start with the simplest version. The United States was a consumption machine with deep capital markets. China was a production machine with scale, labor, and a national focus on industrial build-out. That's the core complementarity. One side specialized in demand, brands, and finance. The other specialized in making things cheaper, faster, and at enormous volume. Timing mattered. From the 1980s through the early 2000s, global business chased efficiency, not resilience, efficiency. Companies wanted one thing above all else, a supply chain that cut unit costs and kept shelves full. China offered that, at a scale the world hadn't seen before. China's WTO entry wasn't just legal paperwork, it was a coordination signal. It told global firms, the rules are becoming more predictable, and the channel is opening wider. Perceived risk fell. Investment followed. On the U.S. side, the logic was equally clear. Offshoring lowered consumer prices. Lower prices reduced inflation pressure. Lower inflation gave central banks more room to keep financial conditions loose. It wasn't one policy. It was a feedback loop, and it felt good in real time. Design in California, components from a dozen countries, assembly at massive scale, shipped to U.S. and European consumers who wanted affordable upgrades every year. This wasn't naive globalization. It was incentive alignment. Corporations, consumers, and policymakers all got something they wanted. Part 2. The Golden Age. What the system delivered. The model delivered 4 big outcomes. First, cheaper goods. Electronics, apparel, furniture, toys, tools. Household life quietly got more affordable relative to features. Your phone got smarter. Your TV got bigger. Your appliances offered more for the same money. Second, higher corporate margins. If input costs fall while brand pricing power holds, margins expand. That's not ideology. That's arithmetic. Third, a new corporate structure in the West. More asset-light firms, more outsourcing, more focus on design, marketing, software, and distribution, less focus on running factories domestically. Fourth, export-led acceleration in China. Scale production, plug into global demand, GDP rises fast. Labor moves from farms to factories, cities build ports, highways, and industrial parks. The machine reinforces itself. You can see the scale in the numbers. In 2024, global merchandise exports totaled roughly $24 trillion. China alone exported about $3.6 trillion, roughly 15% of the world total. That's not participation. That's structural positioning. On the U.S. side, trade became massive and lopsided in goods. U.S. Census data for 2024 shows goods imports from China around $427 billion, exports around $132 billion, a goods deficit of roughly $295 billion. In the Golden Age logic, this didn't look like failure. Consumers got low prices, companies got margins, China got jobs and investment. The U.S. got low goods inflation and strong corporate earnings. For a long time, the pain wasn't loud. It was local, uneven. National averages hid local damage. For years. Part 3. Where the tension started. Cracks. not collapse. The tension didn't begin with a speech or a tariff, it began with distribution. Benefits were broad but not equal. Cheaper goods helped almost everyone. But job disruption hit specific regions hard. Manufacturing towns, supplier ecosystems, places built around one employer, one skill stack. That's the first crack. Nationally, consumers feel a mild win at checkout. Locally, communities feel a deep loss in wages, identity, and stability. Second crack. The trade deficit became symbolic, not just an accounting number, a political one. We buy more than we sell is easy to turn into a scoreboard. Third crack. Technology diffusion anxiety. Deep integration transfers know-how, not always by theft, often by repetition. Training, supplier development, engineers moving between firms, ecosystems learning fast because they operate at scale. Fourth crack. China moved up the value chain. This part often gets missed. The model didn't freeze China in low-end assembly, it trained capacity, and capacity learns. Low margin turned into higher complexity, then into strategic components, batteries, telecom equipment, advanced manufacturing inputs. Eventually, AI-era supply chains. The model became visible and harder to tolerate. Part 4. The scale problem. When working creates backlash. Here's the uncomfortable truth. Small imbalances can persist. Large, persistent ones become political events. Think of a city. If one neighborhood gets all the traffic, noise, and pollution, people eventually vote. Even if GDP is rising. The US-China model scaled so well, it stopped being trade and became a national dependency map. Corporations optimized for cost. They concentrated suppliers. They reduced redundancy. Just-in-time systems looked beautiful on spreadsheets, but they created new sensitivities. Supply concentration, industrial hollowing out fears, political feedback. The benefit of a cheaper toaster is quiet. The pain of a plant closure is loud. This isn't moral judgment, it's how politics processes economic change. And once politics enters, economics stops being the only judge. Part 5. When partner turned into threat. The shift is psychological, but grounded in structure. Early phase, opportunity. Later phase, dependency. Concentrated supply chains become exposure. Dual-use technologies become security concerns. That's how semiconductors, advanced tools, and software move from industry into strategy. Not because people got emotional, because in the AI era, compute is leverage. China's perspective shifts too. Reliance on external markets and choke points feels risky, so domestic capacity grows. Partners diversify. Self-reliance becomes policy. Both sides move, not necessarily toward conflict, but toward risk reduction. Key line. When trade becomes strategic dependency, it stops being judged like trade. So why did the US-China trade model work? Because it matched the incentives of its era. Efficiency over redundancy, low prices over resilience, margin expansion over industrial depth. Why did it become unsustainable? Because it worked too well, and too asymmetrically. It scaled into a distributional and strategic problem politics couldn't ignore. The system delivered exactly what it was designed to deliver. But systems aren't judged only by efficiency. They're judged by tolerance, by perceived fairness, by exposure to risk. Episode 2 will look at what the US is actually trying to stop. Not in slogans, but in structure. Stay curious, stay sharp.